Hi, folks. Happy Canada Day to our American friends. Happy July 4th. It's that time of year again when we start to think of, life, liberty, and the pursuit of happiness for our American friends. And when we look at some of the geopolitics around the world now, you think back to the Declaration of Independence and what it meant splitting away. You think about Ukraine and Russia and the turmoil that war causes in the world, and of course the benefits of peace. Obviously, the more peace we can have and the less war we can have, better for the world. It's beyond concerning. The aspect of East and West clashing. Different philosophies on how we should govern, but even within, the U.S. and within Canada, the political divide keeps separating. I've said for a long time, inequality is a real big issue, and all these things, I think, and sadly, are creating a lot more headwinds. The global economy could be in much, much better shape if it weren't for all these warring factions. And sadly, I think for the next decade plus, we're going to be, the benefits of the peace dividend when the Berlin Wall came down and the building of the internet and all the benefit that caused, a lot of that is going to come undone in the deglobalization of the world and the split between the East and the West and the different ways the world views that we have. So what does that all mean for the radar view this week? I think there's a lot of headwinds to come. Let's take a look at some of the charts and hopefully get a little bit of clarity here. So S&P 500 is where we always start. Parts of the day this week really looked good earlier in the week. I've been talking about these gaps closing back here where we broke down surprisingly on the May CPI report that comes out in June, and you can see the gaps there. We closed the first gap. There was Wall Street firms, many of them reported their estimate of quarter-end, month-end rebalancing was going to cause this massive move into the end of the month. Very possibly the move on the 24th and 27th was a front running of that, and the actual buying that came in, just didn't materialize. So you would say guys that are indexed, did they not rebalance? And the answer is probably no. But you're seeing a pretty good reaction here to some weak economic data that's come out in the last couple of days, and I think it's really pretty material what's going on now. So want to have a look here at another chart and do another share with you here, and this is the Atlanta Fed's forecast of GDP, called GDP Now. And you can do a quick Google search, Atlanta Fed GDP Now, and come up with this. And there's a lot of details here, but essentially we found out this week and confirmation Q1 negative growth. The estimate now from the Atlanta Fed for Q2 is now sharply negative growth. And it's really important to look at the components of GDP in this forecast and get a sense of where the drag is coming from. So as the quarter progresses and now as we get more and more economic information, the GDP Now tracker updates the estimate, and pretty much for the whole quarter kept falling and falling and falling. Well, in the last couple days of June and today, July 1st, the GDP numbers that come out with the PCE and NIPA numbers, so you've got national income and product accounts. This is extraordinary detail in terms of production and income impacts. So PCE is the personal consumption, what people are consuming and buying. It's much more high profile, high frequency. And what you can see is that consumption is still actually very positive. However, from the initial estimates at the end of April, 2.5, down to 0.5% now. And so we see a drag in terms of equipment spending. So, investment is a big part of that. Intellectual property production, that's kind of a relatively new thing that's been incorporated. But the business investment, non-structural investment, residential investment, government spending. So you can see some of the drags in here, but really the CIPI account, when you look at CIPI, you can see the note here. CIPI stands for changes in private inventories. So this is, inventories of production way down. And that just speaks to the supply chain challenges we continue to have. And at some point, there'll be a big boost to GDP when a lot of these channels come back into play. Question is, when is that going to be? And how long does consumption hold up? Because consumption ultimately is about national income and about jobs. Some estimates now, by the end of Q3, we will start to see the unemployment rate start to tick up. And that would be the official harbinger of the National Association of Business Economists, probably calling the recession is already in play and started earlier this year. What we have yet to see, of course, is analysts turn down their earnings. So all of this has come into play, and I think is really starting to impact markets. But a lot of bad news is in the tape. We see that in what the bond market is doing. We see that when we look at 30-year and 10-year bond yields and what the yield curve is doing. But if we look at the last couple weeks here on Treasury bonds, which we'll grab a quick look at here as I change screens, we have a look at what the bond yields are showing us. And what you can see here is that the 10-year yield that spiked on the inflation concerns up to 3.5, and this is when that data print came in, actually has reversed down to negative. So the Fed's getting ahead of the curve. The bond market is starting to price in that recession. It's pretty clear from the forecast of GDP. Never mind what the street thinks, what the more likely output number is from GDP, that we're going into a recession. And ultimately, folks, what that means is the Fed is not going to have to tighten as much as what's priced in the curve. And that now is coming in front of us. So what we have to balance here is earnings downgrades over the back half of the year, with the understanding and expectation that the Fed probably isn't going to have to raise interest rates as much. Let's have a look at what couple of key companies said about earnings as we look at our bull and bear picks of the week. So the question is, when do you step into these more cyclical names? GM came out on Friday and talked about inventory issues. They maintained their revenue and target numbers for the year, but downgraded the quarter that they're going to report in a couple weeks. Oversold, overbought. GM looks really attractive here to me. You had a period of a number of years where this stock was just in a range trade. I think the dynamic of the next decade with GM, I think, being a leader in greening their cars, Volkswagen, NIO out of China, obviously Tesla, but I've said for a while, Tesla is a bad stock. Great company, bad stock valuation. GM, extremely attractive right now, as is Volkswagen, as is NIO. Another big name that came out this week, Restoration Hardware, and talked about, the consumer slowing, and when does that get fully priced in? One of the things you can see here, and you got to keep in mind about analyst estimates, is they've been pretty consistently wrong, and they end up chasing one way or the other. And what the company says, then they up their targets, and then what the company says, they downgrade their targets, and they chase the market. And general analyst consensus is not something, you know, you kind of want to look for. You want to look at the charts and how oversold things are. But from a valuation perspective, Restoration Hardware as well is starting to get very, very interesting. And it's not surprised here to see these stocks flip, like GM on bad news flipped, turned bullish on the day. Restoration Hardware this week, again, bad news on the name, flipped and looks very oversold, and behaving a little bit better to some of the bad news after a couple of days. So those are the bull picks of the week. And on the bear side of the week, you know, you just got to be cautious. I think we can bounce again here. S&P 500, let's have a look at it as we're getting close to the close here on Friday. This channel over the next month as we project into July will run into a lot of overhead resistance in the 40.50 to 41.50 range. There was a period there of a couple of weeks. That's where I think we're going to target by about mid-month. And at that point, you know, get very cautious again on most of the names in your portfolio that are cyclical. Have a great week. Happy Canada Day. Happy 4th of July to our American friends. And let's hope there's more peace than war, but I fear that's a challenge.